everybody. Luke Gromen, FFTT. Hope everybody is well. We are hunkering in here for this, so far this year's edition of the Storm of the Century. So hope everybody's staying warm, staying safe out there. I know we are certainly doing so. Hope you had a great long weekend. So with that out of the way, let's jump into the questions. First, we've got what I would say is the most important question from KLT. Who are the Browns drafting? And a follow-up, what percentage chance do we have a win in the 2022 Super Bowl? So for me, I think the Browns need to be drafting a very athletic linebacker to spy Lamar Jackson, since we have to play him twice a year for the foreseeable future. Also think we need another shutdown corner to go along with Ward. If we do that, I think we'll be very competitive. I don't want to say we're going to be in the Super Bowl, but I do think we'll be competitive again this year. So it'll be another year of fun Browns football. So with that, let's get to the macro and the economic stuff. From NP, am I a buyer of Bitcoin at today's prices? Yes, I continue to like Bitcoin, even here, with the caveat that it is very volatile and is likely to remain very volatile. Secondly, from AI, any concerns about the near to medium term over the next few months as it pertains to this reflationary cycle? Is it vulnerable? And also any concerns the Fed chooses not to accommodate the rising fiscal spending and reacts by tightening? The short answer is yes. I do think it is vulnerable really at any time, simply by virtue of whatever the Fed does. And really, I think it depends on the net impact of the Treasury General Account, or TGA, rundown that we're seeing that's supposed to happen pretty aggressively over the next 5 months. It's supposed to run down from, call it, $1.5 trillion to I want to say 500 billion or even less over the next. So there's a lot of dollar liquidity being injected by that will, all else equal, be inflationary, put downward pressure on the dollar. Against that, you have to net what the Fed is doing in terms of buying enough treasuries. In 2022, they bought enough treasuries. The fourth quarter 2020, they really stopped buying, quote unquote, enough, and that represents tightening. So if you have the expansionary fiscal with not enough Fed buying and no TGA, you're going to be running effectively Brent Johnson's milkshake. You're going to have stronger dollar, capital flows here, rates up, stocks up for a while till something breaks. The net against that is what the key is, what's the TGA do? And if the TGA is being run down in a big way, I think we're going to be okay on the reflationary side, but it is definitely something that is fragile depending on what the Fed does and if the Fed is doing enough at any given moment relative or net of whatever the TGA is doing. From David, regarding the latest interview with Russell Napier on Real Vision, he shares your view on yield curve control and financial repression. He differs on the question of central bank balance sheet expansion to soak up the government debt. Any update on your views? I've not had a chance to read that yet. So I'm watch it yet. So I'm not sure how we differ in terms of soaking up the government debt. My view is essentially that the Fed's been basically married to the Treasury, and that means that increasingly going forward, the key metric to watch for inflation is going to be not private sector bank loans, but rather bank loans to the U.S. government. In other words, U.S. deficits and the rate at which the U.S. banking system buys treasuries. Last year, banking system treasury purchases were up 20% plus year over year, so quite robust. I think they're now getting to a size where on a net basis, you really start to see that impact. But the key is that basically means the U.S. government's in charge of inflationary pressures increasingly going forward, not the private banking sector, as has been the case for the past 40 years. So let's watch that. From Matt, thoughts on UBI or helicopter money as a masked attempt at a soft default on debt via inflation, but framed politically as taking care of the people? I think that's essentially what's begun. And I think COVID is a very, very politically useful cover to do that. And that's not to say COVID is some big conspiracy theory. I just think that it is politically difficult, if not impossible, for anybody in Washington to stand up and be a deficit hawk for as long as we have the COVID political cover that we're doing this to build back better, to use President Biden's words. And so I think that's already begun. I think it began last year. I think it will continue in fits and starts as different political concerns about the size of spending, like we saw in the second half of last year, weigh on it. But ultimately, I think we have begun down that road, and I don't think we're going to stop going down that road for the foreseeable future. From KH, where are you at with the Bitcoin versus gold conversation? I like them both still. I think they're both neutral reserve assets. I think Bitcoin is better on a lot of metrics than gold in terms of being what gold has historically been gold for. With that said, I still think there are two things that gold does better than Bitcoin and makes it every bit as important to hold, in my view, which is gold is final settlement. In other words, gold, you hold a gold coin, it's final payment, it's final settlement. There is no energy debt owed to that gold coin or that gold bar. In contrast, if you hold a Bitcoin, there is an ongoing energy debt that must always be paid via the electricity, via the network that supports the value of that Bitcoin. The other thing is that Bitcoin is not on central bank or sovereign balance sheets, and gold is. And so, if there comes a moment where there needs to be a binary resetting of the system, the only asset really available to authorities is gold, not Bitcoin. So, continue to like them both, though. From WD, please explain in contrast to gold. I've concluded that far from wanting to ban Bitcoin, key U.S. authorities now see it as a positive and maybe even critical for the U.S. and the dollar for Bitcoin to rise to very high prices. I touched on this in my interview, my Real Vision interview with Ed Harrison 2 weeks ago, and he asked me about what I thought about Mike Green's recent conversation with Pomp on Real Vision regarding Bitcoin. And my point is that there are people that are aware. There are people in Washington, and particularly in the defense and intelligence establishment, that are aware that the euro-dollar system is being used by the Chinese against the U.S. So in other words, right now what's happening is China borrows dollars. They lend those dollars out at a spread along the Belt and Road. They use those dollars to secure, they lend those dollars against hard asset collateral. And that builds Chinese political clout, geopolitical clout, economic clout. And that then creates a dependency on emerging markets on China. Now, if the dollar gets too strong, the weaker of those emerging markets, one of two things happens. If the weaker of those emerging markets start to default on those Chinese dollar loans. Number one, China gets the hard asset collateral, which is what they wanted in the first place. So China wins. Or in theory, what we've seen, in fact, the Fed comes in and supplies dollar swap lines to the weaker emerging markets to prevent a dollar contagion, thereby making China whole on their dollar loans. So you've got China borrowing dollars, lending them at a spread to gain political and geopolitical and economic clout to emerging markets to secure resources. And these loans are being backstopped by the Fed under the auspices of the Fed having to backstop the eurodollar system. All of this is to basically keep the dollar stronger than it would otherwise be. And all of that is hollowing out U.S. manufacturing as it happens. And sort of as I put it in the Real Vision interview, the cherry on top of this incredible sundae is that the U.S. military defends the trade lanes to allow China to bring these hard assets and finite commodities back to China. So my point here is a long-winded way of background is saying there are parties in Washington that understand how the existing eurodollar system is being used to strip the United States of its hegemony, paradoxically. And if you understand this paradox, then you would not see as negative an asset that begins to put pressure on the existing eurodollar system like Bitcoin will eventually do if it continues to do what it's doing, and if it does what some of the Bitcoin, the most vocal Bitcoin proponents think it will do, and which I think it has a legit shot of doing. So that's why I think ultimately there are some interests that in Washington that I think are rooting for Bitcoin to do very, very well, because ultimately it would put pressure on the dollar. Putting pressure on the dollar would allow the U.S. to basically take the dollar down to a level that would reshore, we'd be able to re-strengthen, reshore supply chains that we can't with the dollar at current valuations with the eurodollar system as currently structured. And then finally, from BC, why don't you call Bitcoin a bubble? Because the bubble is sovereign debt and by extension, fiat currencies. If I look at Bitcoin in particular, I'm not talking about all cryptos, I'm talking about Bitcoin. We have a finite issuance. Okay, so we got 21 million Bitcoins someday, 0% yielding. My alternative is the U.S. CBO says that the U.S. is going to run between $1 and $2 trillion in deficits every year for the next 9 years through 2030, and that assumes no recessions, no wars, no other pandemics. Everything goes swimmingly. 1 to 2 trillion a year more every year in treasury issuance, and those treasuries are also de facto, particularly at the short end, yielding zero. So I can own an asset that is finite in issuance, yielding zero, or I can own an asset that is infinite in issuance, basically yielding zero. I would rather own the finite asset. And the other issue, and why I say that sovereign debt's the bubble, is debt levels in the U.S., in Western sovereigns, around the world more broadly, as well as corporate debt levels, as well as consumer debt levels, are so high. But in particularly for the sovereigns, they're so high that these sovereigns cannot afford to pay a market rate of interest. They have to have their central banks keep real interest rates negative for them to not nominally default on their sovereign debt or their entitlement promises. And if that's the case, once again, I would rather have a 0% yielding bearer asset with finite issuance than an infinite issuance 0% and realistically a negative real rate bond whose face value can't rise to compensate me for those negative real rates, unlike a Bitcoin whose face value, as we've seen, can absolutely rise to compensate me and protect my purchasing power during the period of negative rates that all governments, especially Western governments, especially the U.S., need just to keep the wheels on the cart for the foreseeable future. So to me, the bubble is sovereign debt, not Bitcoin. It's not stocks. It's not real estate. It's sovereign debt. And by extension, it's the currencies, because sovereigns aren't going to go bankrupt. They'll print everything they need to keep themselves from going nominally bankrupt. So that's it for tonight. As always, thank you for joining me. If you're interested and like these kind of updates, check us out at FFTT-LLC.com for FFTT tree rings. I have a weekly piece, 10 most interesting things, lots of good information, and some thoughts on what grabs us about each of those 10 things and how it relates to what's going on. As always, stay warm, stay safe out there, and we will talk to you all soon. Take care, everybody.